If you have any questions, you can ask. If I can't answer, I'll have to get back to you. I may have to, talk with Gail or Jill, if we need some detail. It's in the same format as it was in the past. So the first thing, we'll look at the table of contents. I'll tell you who belongs to what. The independent auditor's report is ours. And the supplemental reports are ours. Everything in between there belongs to the township, and that's what we're auditing on. Just like to point out, there's a couple of new things in here this year. Under the other financial information on pages 58, 59, and in the contents, you can see that's just a schedule of federal awards. That's new. You didn't have that in the past. And then there's the notes that go with it. And that's, and then there's also another supplemental report that reports on that schedule. And that's due to you having a single audit because of the sewer project, and you spent over $500,000 of federal money. So we had to put that as another auditing requirement that had to be put in place based on Office of Management Budget Circular A133. So we'll talk about those letters again, and you'll probably have that again this year, because it looks like you're going to be spending another $500,000 in federal money on your sewer project. If you're under 500, we'll go back to just having the one compliance report. But that's why there's two this year, and that's why there's that separate schedule, is because it was a single audit. But even if you don't have a single audit, there is some additional reporting that's required by the rural development. So there is a couple extra steps that have to be done to satisfy them that the loans are being paid and that sort of thing. But that's why there's those extra pages in the report. And the next thing is our opinion on pages 4 and 5. Basically paragraph number 3 in the last paragraph. What we're giving you there in those two paragraphs is a clean opinion where we say the statements are presented fairly in all material respects. We say that for the financial statements, and in the last paragraph we say that the federal schedule of federal awards is fairly stated in all material specs. So those are clean opinions. That's a good opinion, unqualified opinion. It's the same as you've had in the past. Next thing is here's the management discussion and analysis. I won't go through that, but that was prepared basically by Kim. We gave a rough draft to help make sure there's certain requirements that need to be in there. So we gave her a rough draft of the prior years with new numbers, but she had to fill it in to make sure it was in the future considerations and why things are different. But that's a good thing to look at. That's a recap of everything that happened for the year. And then we'll just go to page 17, which is the balance sheet for the governmental funds. And again, this is like a snapshot of what was going on December 31st, just that one day. I'll just point out a couple things here. The general fund, the fund balance went up in the general fund by about $962. Last year that dropped by about $26,000. And you can see there in the fund balance, there's some of it is reserved for prepaid expenses, about $15,000. Some of it is reserved for park development, $4,750. That's $4,000 from Walmart over the past few years, and $750 from the Steiger family some years ago. Then in the designated, this is what the board has designated. There's $15,800 designated for park development. That's $10,000 that you guys set aside a couple years ago, and it's $5,800 of money from logging at the airport over the past 2 years that you've designated to be for park improvement out there. Then there's the $62,000 that's going to be sitting there until 2043 when the landfill closure can be completed, and the Michigan Department is going to keep that there until they're sure that there's not going to be some problems with the landfill closure. That's there for any additional cleanup or anything like that. One other new line item on there is under assets, there's other investments, $31,000. What that is that's what it costs you to buy the trailer park. and we put it in other investments because you're trying to sell it. If it stays there for over a year, we'll have to take it out and call it a fixed asset, and we'll have to take it off the balance sheet and put it in your list of assets that you're holding. But as of right now, it's for sale, and the idea is for you to sell it. That's why we left it as basically a current asset. Hopefully you can get it taken care of and off the books and back on the tax bill.
A question for you: if that were to take place at last longer than a year, do those trailers then become personal property that were subject to taxation? As far as personal property tax, does that become ours?
They used to do a trailer park fee when they ran it as a park and they paid the state. They didn't have it on the tax roll as personal property.
Okay, so it wouldn't be if we were to have it for over a year?
I don't believe so.
Okay.
And then the non-major funds, that's your Township Improvement Fund and your Special Grants Fund and Perpetual Care. The Township Improvement Fund actually dropped from about $1,100 down to about $1,000 because you transferred $9,700 out of it last year to the general fund to help with the cost of the bike lane on the highway. And then the other two funds are pretty much the same as they were last year. The Special Grants Fund has $5,000 of deferred revenue in it that's been sitting there. That was given to you by Kmart many years ago to be used for economic development. So it's sitting in there with the rest of those economic development funds. And there's about $73,000 that's sitting there, which is for you to re-loan out to people. And I know you've got all the requirements in place, and I think you've already loaned some money out, haven't you? I know when I was here auditing, you were in the process of doing that. So you did loan out $50,000 on that. So that's turning over like it's supposed to now. It had sat there for many years now. Got it cleared up and started to use it what it was for. So. And on page 19 is the activity for the year. And that's where you can see the fund balances went up. And the other non-major funds went down by, like you said, about $8,000. And that's because of the transfer out. And there's really nothing really too exciting there other than you do have proceeds from long-term debt listed in the general fund, and you have capital outlay. That's where you borrowed the money and bought the fire truck. We'll be talking about that again here when we get down to the findings we have. And then the next thing to look at is the water and sewer funds on page 21, 22, and 23. The water fund balance went up about $35,000. The sewer fund went up only about $2,400. Both of them actually have pretty good unrestricted fund balances. And the water fund is in pretty good shape for this future, but the sewer fund, in that unrestricted balance, is an investment in the Gogebic Iron Wastewater Authority, which is really not cash that you can use. So I think, and we talked about this in our exit conference for when we were done with the audit. What I'm thinking is going to happen there, and Dwayne Reed actually called me and asked me a few questions about the audit, and if you haven't got a call from Dwayne Reed, you're going to be getting one to consider raising the sewer rates to make sure you have enough money to cover the bond principal and the interest that's going to be due on the new bonds. So that's just pointing that out to you that I think that's coming up for you guys.
What do you mean? They're going to raise the bond, or?
No, you have to raise your rates so you're taking enough money to cover the cost of the bonds.
Oh, okay.
Right now, it's really tight, and I think some of your ratios aren't going to match with what rural development's going to want. So if you haven't got a call, you're going to be getting a call, because I got a call. You wanted to ask me a few questions about a couple of things, and one of the things you did ask me about was the bad debt that you had on there. And we had put a bad debt on there 2 years ago, knowing that at some point you're going to have to give the money back to the county where they paid you for the delinquent utilities on the trailer park. We took an estimate, and our estimate was low, so it actually came in, we had some expenses this year, and he was wondering if that was going to come back again.
Oh, okay.
We told him that was a one-time thing. So, and he just asked a couple other minor little things, but he did he didn't come right out and tell me, but he was talking and the way he's asking the questions, I would gather that he's gonna be calling you guys about, working on getting your ratios up and getting some more cash flow to cover those bonds. Just giving you a little warning there.
How much money do you need to make them happy?
I don't know the answer to that. He's gonna have it all, he'll have it all worked up for you, I'm sure. So. The next thing we should, I don't think we need to cover all the notes, all those notes from the financial statements are just supplemental information. But if you go back to supplemental reports, A and B, those are the two reports I was talking about. The A report is the report on compliance and internal control for government auditing standards. And the B report is the report on compliance with requirements for major programs under the Office of Management and Budget. And the findings are summarized on page C1 and C2 to the end there. And basically what there was is there's seven findings for the government auditing standards, and there isn't any for the federal program. Those findings basically are, there's one new one and the other ones are, they've been there in the past couple of years. First one is the budget, and basically what they're saying there is you overspent your budget. And the reason that happened is you budgeted to pay the loan on the fire truck, and you budgeted to take in tax revenue. But really you borrowed, and that was $76,000, but really you borrowed $290,000 and bought a fire truck for $290,000. So your budget was low on the revenues and it was low on the expenses. So when you set up your budget, you should have used the actual purchase of the fire truck, not the payment of the bond or the loan that you got on it. So the next one is auditor prepared financial statements, and again, like every other year, that's similar to all the small units in the area or in the state. School districts, townships, some small cities. Basically what they're saying there is, if the auditor helps you with the report, you might have a problem with your internal control. Auditors have been doing reports since forever, and all of a sudden they decided it's a problem. And what we're saying is it's not worth it for you to hire an accountant of your own that has that knowledge, or somebody to go to school and be trained to do the report, because it's an ongoing thing with all the new requirements. And we're basically saying to just continue having us prepare the report. We've had that for the last couple of years, and if you look on the internet at any other small entity, they're going to have that exact same finding. The next one has to do with audit adjustments, and this is similar to the prior year. And basically, we made quite a few adjustments. Most of them are routine, but they should be done before we get here. But we make them, and we give a copy to the clerk, treasurer, and supervisor, and they look them over and we approve them. The next one is the segregation of duties, which you've had for the past couple of years, and what you have going on there is, you have your statutory guidelines with the clerk and the treasurer and supervisor, but what's happening is the treasurer is basically handling all the billing for the utilities. So there's a little bit of segregation of duties problem. There's nobody actually looking over as much of it as could be. And there is things that are being done now. Kim is looking at monthly reports to see if there's any adjustments being made, and working on getting the deputy clerk and the treasurer to do more work, and then it's spread out amongst more people. But that problem is mitigated by the oversight of you guys as a board and Kim looking at the monthly reports. The next one is in the receipts. This was kind of there last year, and it stayed about the same, but deposits are made basically timely, but sometimes a receipt doesn't have a description on it, so that slows up the accounting recording into the system, and then so it has to get put in, and then the description can be put in later, then it has to get changed in the accounting system. Some of them were corrected, some of them weren't. So we're just saying that descriptions and so on should be done more timely so that it keeps the flow of the books going. The next one is the tax collections, and according to the Property Tax Act, you have 10 days to distribute the money out to other units. We had a couple of instances where it wasn't done, like for instance, the general fund doesn't get their money until towards the end of the collection period, which is not a big deal because it's your money. You know, it's sitting in the tax fund rather than your checkbook. So, but it's there. And there's a couple of entities that actually ask you not to give them their money till the end. But that's wrong. You got to give it to them in the 10-day period. Even though they don't want it, if something comes up down the road, you don't want it to come back and say, oh, you know, you're not following the property tax act. So you need to make sure you get on top of getting those things out and zeroing out that account on a 10-day basis. Then the new one is the bond covenants. The revenue bond ordinance for the sewer fund requires that receipts be segregated, and there should have been some reserve accounts set up. And at the end of the year, those reserve accounts weren't set up. They were set up shortly after the end of the year, and I think when we were here, they were just starting to get used. They weren't quite being used like they're supposed to. And I believe you're going to be able to, Dwayne Reed probably would help you out with making sure those are working. But they were set up, so we don't see it as a big problem because they did get set up. But they should have been set up probably in October when the money was flowing in and out for that. And there's like 3 or 4 reserve accounts that are supposed to be set up. But again, some of these, you know, most of these were noted in last year's audit. 2 years ago, there was improvement. From last year to this year, it was kind of level. It stayed about the same. I guess what we're kind of saying is you need to work on the receipts and collections and get those in the system. And then the books need to be posted more timely, and then some of those adjusting entries that we make need to be made before we get here. And some of them, like I said, are routine. So they, you know, if everything gets flowing right, they can be made. Next thing I'd like to just mention is something new coming up for 2011. The Governmental Accounting Standards Board, in their wisdom, has now changed the way you report your fund balance. It used to be restricted, reserved, designated, unreserved, undesignated. And now they've made it non-spendable, restricted, committed, assigned, and unassigned, which basically is about the same thing as what it was before. But they have different definitions, and they've divided 4 things into 5 things. It's not going to make a difference in any of our lives, I can tell you that. But the non-spendable, that's your prepaid expenses. The restricted funds are the things that are restricted by an outside party, which would be like the donations you got for park improvement, that's an outside party. That landfill that's restricted by the state of Michigan wants you to keep it there, that'll end up being restricted. Committed funds are funds that are set aside by board action, by the highest authority of the township, which is the board, and that would be the $10,000 you have set aside for park development and the logging funds that you set aside. And those are what they're going to call committed funds. Then there's a new one called assigned balances, which the board may not assign it, but maybe Kim, Jill, or Gail as officers may see a need to assign something. So it has a lesser, you know, commitment, but it's something that they feel should be noted in the report that there's going to be money spent in the next year, so we need to set aside some money. And the thing that's kind of in there is like most of that stuff is committed, because if it's in your budget for the next year, you've already as a board committed. Like if your fund balance in your budget says you're going to use $9,000 of your fund balance, or $10,000 or $20,000, well, you've committed that money. You don't need to, you know, do another board action. So then unassigned is the rest of it. So I personally don't see the big why they did this, but it just adds another little project for us for you guys to set aside. And we've given some information to Kim already, and for her to look at, and you'll probably have to do some board resolutions, you know, concerning this. And then they did make another change, which I think is actually a good one, is they're saying small little special revenue funds that don't have substantial income shouldn't be there. They should all be in the general fund. And you actually have you'll use most of it, but the township improvement fund sat there for years, all it did was get interest. What they're saying is that that's just sitting there, put it in the general fund, get rid of that. And the other one is the perpetual care. I mean, all that goes in there is a couple of dollars from cemetery fees. They're saying you don't need that fund, put it in the general fund. So you're gonna need, in 2011, to take those two funds and incorporate them into the general fund. You don't wanna do it on your books, you don't necessarily have to actually do it in your accounting records. But when we do the audit, we're gonna move them over and put them in the general. I think that's actually an improvement, because there's a lot of places that have all kinds of little special revenue funds that they had a purpose 10 years ago and they're still sitting there. So, and again, those will require some board action, and like I said, I did get some stuff to Kim to work on for that. So, I see you're all still excited. But that's about all I really wanted to go over. And again, the finances are in good shape. The staff is very helpful, and they're striving to be more efficient. But again, some of the comments have been there for a couple of years now, so you're going to need to work on those. And I will be stopping in. I'm going to try to stop in each quarter here to see how things are coming. Just sit down and we can't do a whole lot because we can't help do your books, but we can make some suggestions or just make sure some of the things we talked about are being done. And then again, you're going to have to monitor that sewer fund and find out, if there's rate increases needed. Because you don't want to wait too long and get behind it. And if there's anything any questions, I'll try to answer them right now. Well, you know what? I knew you were going to ask questions.
Just two quick ones. In your opinion, then, all the deficiencies you've listed are either structural or because of our size or been addressed?
The receipt coding needs to be addressed.
Okay.
That has to be done more timely and right up front. And the tax collections need to be out in 10 days. The tax account needs to zero itself out, and it should zero itself out. Really, if you look at the tax fund, that's not the tax fund money. When it comes in, it should go out to whoever it belongs to, the school, if there's refunds to citizens, to the general fund, to the county, to the college, wherever it needs to go, it should go out. So those are the two things that really need to be addressed.
Okay.
And the use of those reserve accounts.
In the findings and questions at the end, under C on page C1, item number 9, is that worded correctly there?
I believe it's not. You're not a low-risk auditee. That is correct. And the reason
So we are a high risk.
And the reason you're a high risk, before you panic, because you've never had a single audit before.
Okay.
And if you don't have a single audit for 2 years in a row, you have to be a high risk. So if you have a single audit again, you'll be a high risk again. And what that means is when you, in your case, it's not a big deal because you only have a couple of federal programs. But a place that has like 35 federal programs, if you're low risk, the audit has to be, compliance audit has to be on 25% of the total. If you're high risk, it has to be on 50% of the total. For you guys, it won't change anything because you're going to have one program that's going to be over 50%. But that is right, you're not a low risk auditee because you have not been subject to a single audit in the past.
So Dwayne Reed will give us what we have to.
I'm assuming he's going to be calling you up, and he'll have worked through all the ratios. He'll look at your cash flow, and he'll come up with something saying, where you have to be on your rates.
Did Reed get a copy of this?
Yes, he did. Yeah. When he called me that day, he actually referred to a couple of pages, and he said he actually has a copy of it. Yeah.
Thank you.
Thank you, Tony. Thank you.